My name is Christopher Hatch. I am the senior associate here on LaunchTN's capital team, working across several of our funds, and I will be your host for today. And super excited that everyone has decided to join. These calls happen quarterly. This is the Southeast Capital Call. It is our effort to be a part of the larger Southeastern startup ecosystem. We are a public-private partnership with the state of Tennessee, which our amazing Chief Investment Officer will give you a little bit more color and information about here in a moment when she does the welcome. Other than that, we keep this pretty casual. This is an opportunity for investors from around the Southeast to connect, to share deal flow, to find out about cool events that might be happening in a particular market, like the one that Meg mentioned earlier. And so definitely use this as an opportunity to network, to catch up with old acquaintances and associates, and just to continue to build relationships. And so without further ado, I'm going to go ahead and pass to Eller Kelleher, our Chief Investment Officer, who will give our welcome.
Awesome. Thank you, Christopher. And it's so nice to see so many familiar but also new faces on the call today. Really happy to have you join us. As Christopher mentioned, we host these quarterly. We are always looking for feedback on topics to cover. This one was particularly interesting just as we have a fantastic relationship with but the Federal Reserve, and in fact, Dr. Parrish is the uncle of one of our team members. So we had a family member economist plus a great relationship with the Federal Reserve that it made for what I hope and I know will be a really engaging conversation kind of on, again, the state of the economy and what the implications are for startups and fund managers. Everyone on this call is really an LP, or excuse me, a GP, and well, either you're an LP or a GP, which is the perfect transition for me to talk about LPs and GPs exclusivity and like creating space for us to connect and talk, maybe sometimes in the absence of founders. It's wonderful. We all love founders. They fuel the work that we do. But I think creating this type of space where we can actually, again, talk without that distraction, ask each other questions on how are you thinking about your investment strategies? How is fundraising going? How's fundraising going for your portfolio companies? What we found is it's a very productive time, although it is over Zoom, so it can only be as productive as Zoom breakout rooms allow. So that is me now making the segue to, wouldn't you love to be in person for some of these LPGP connections? I just want to remind everybody that September 9th through 11th, LaunchTN will be hosting our 3686 conference. Again, the bulk of the programming happens on the 10th and the 11th. The 10th, we have amazing speakers coming from all across the country, really content geared towards industry specific topics. So we'll bring in sports and entertainment, music, healthcare, AI. We'll cover all sorts of topics. But what I'm most excited about, particularly for this group, is the September 11th day, which we have named our LPGP Day. We welcome all LPs and GPs into the room. We kindly close the doors to founders and entrepreneurs, again, to give you all space to connect directly with one another, share deal flow, talk about some of the struggles that you're going through, talk about some of the wins that you're seeing. So make sure you grab your ticket to 3686, where tickets are on sale. Again, and if there's a time that you've been trying to think, I need to get to Nashville, I want to do a couple meetings, this is a great event to anchor a week-long trip or a couple-day trip to Nashville, because I promise you'll meet tons of other investors who are interested and focused on investing in Tennessee and regionally. So hope to see you there. I'm glad to see you all on here right now. And with that, I'll hand it back to Christopher to introduce our wonderful speakers today. And again, very appreciative to everyone.
Awesome. Thank you so much, Eller. Everyone give Eller a virtual round of applause. All right. So without further ado, I'm going to go ahead and pass to Jackson Broadwell from TNECD.
So, like Chris mentioned, my name is Jackson Broadwell. I'm a research analyst with the Center for Economic Research in Tennessee, which is housed within the state of Tennessee's Department of Economic and Community Development, and serves the department's sort of in-house research arm. My hope for today is to be able to sort of frame up this panel discussion to follow. I'm going to do this by primarily sticking to three main topics. Briefly going to touch on some sort of macroeconomic trends, remote work, and some labor market indicators. And then taking a look at specifically what's going on in Tennessee as it relates to capital flow and labor market. And then maybe we'll just briefly touch on inflation and uncertainty around monetary policy, and sort of wrap up with a brief economic outlook. Like Chris mentioned, I'm going to try to stay pretty high level, and hopefully our panel discussion to follow can maybe get more in the weeds if there's a particular slide or topic that's of interest. But getting on into it, the three primary macroeconomic trends that I'm going to touch on are the availability of capital, labor market dynamics, and commercial real estate. So the AI boom carried all three major U.S. indexes to all-time highs in the first quarter, and we are seeing the same growing hype around AI and venture capital deals. So according to Crunchbase, nearly a fifth of all venture funding in April went to AI companies, with a total of $3.9 billion invested in the sector. This was an increase of 39% year over year, and total global venture reached $22 billion in April 2024. Flat month over month, and up slightly, as you see on your screen, from April 2023. So while total venture capital spending remains relatively stable, there's a noticeable trend of investment dollars flowing into AI-focused companies. Diving a little deeper into that $22 billion number that I mentioned, around $2.4 billion was invested in seed stage companies. That was around 11% of the total investment, and then $9 billion was invested in early stage across nearly 500 companies, and about $10.7 billion, which was around 49% of total funding, was spent at late stage, Series C and onward, and technology growth companies, which is the red indicator you see on the screen. So of that $10.7 billion, that was invested across 150 different companies. So you see, we've obviously come down to the highs of early 2022, but really sort of stabilized over the last couple of months here. Alongside this budding excitement around artificial intelligence, we've also seen layoffs that are disproportionately affecting the tech industry. Last month, Tesla announced that it would be laying off more than 10% of its global workforce. In March, Dell Technologies laid off about 6,000 workers. And in total, Dell has cut 13,000 jobs in the last year. If we look back to 2023, Amazon laid off over 27,000 workers, Meta laid off 21,000, and Google and Microsoft each laid off over 11,000 workers. So, there's a new article every day about which and how many jobs will be impacted by AI. I recently read estimates from the IMF that some 60% of jobs may be impacted by AI in advanced economies. So despite all of the economic and productivity gains, the impact on the tech sector workforce is, something to just keep an eye on moving forward. Lots changed since the initial rise in remote work in 2020. According to Pew, around 14% of all employed adults in the U.S. work from home all the time. But that's looking at all workers. So if we remove, the retail, first responders, teachers from that sample, only looking at workers who can work remotely, just over a third of workers who can work remotely do so all the time. Only 16% of white collar workers say they would consider a role that doesn't offer any days of remote work. and a whopping 42% of office workers would take a 10% pay cut to have the flexibility to work remotely. So that's sort of where we're at today with the labor market. One thing I wanted to mention was sort of how the proliferation of remote work has also imposed these transformations in commercial real estate. Looking at office demand in Q1 was down for the 9th straight quarter, and in-office employment continues to grow more slowly than the rest of the U.S. job market. The national vacancy, the national office vacancy, increased by 0.7 percentage points quarter over quarter. That's from Q4 of 2023 to Q1 of 2024, and that national office vacancy is now at 20.2%, which is the first time on record that it's exceeded 20%. So something to keep an eye on there as well. The construction pipelines decreased 63% since early 2020. But if you're in Nashville, you wouldn't know it. The picture on the screen is of what will soon become Nashville's tallest building. The Nashville Business Journal's Crane Watch tool shows just shy of 200 projects currently under the pipeline. And so, are hoping we can get more into Nashville specific, Tennessee specific commercial real estate later. But is that we're just kind of able to, outpace the national landscape there. Sticking with the Tennessee mindset, now that we've sort of established that national framework, I want to go back to the discussion on capital availability and labor force. Starting with capital flow. So Carta has been looking at capital raised and breaking this down by the U.S. Census Bureau's 4 major regions, so the West, Midwest, South, and Northeast. And the map on your screen shows that in 2020, 0.2% of all U.S. primary capital was raised in Tennessee, and 11.4% raised in the South. Now, if we flash forward to 2023, that percentage of the national share raised in Tennessee is up from 0.2% in 2020 to this 0.51 number in 2023. And the percent for the South, which was, it was 11.4% in 2020, is nearly doubled all the way to 19.6% in 2023. This is a little easier to see here, but you see that, the West Coast is still leading the pack. However, the South's share of capital raised in the U.S. has nearly doubled just in the last 6 years. Really the only of the 4 regions with noticeable positive improvement there. And, still nearly half of U.S. VC money is going to the West. But that region's share has dropped more than any other region in the past 6 years. I will say preliminary numbers for Q1 paint a bit of a bleaker picture for the South, but a lot of capital appears to have been raised on the West Coast in Q1. But this does not detract from the underlying observation that the South is becoming much more intriguing as a VC and startup hub. I know you're all probably interested in these numbers. I'll make sure that we're able to follow up with getting these slides out to everybody, who's on the call. Now, shifting from capital flow to the regional labor force, in Tennessee and in really the Southeast in general, unemployment rates remain positioned well below the national unemployment rate. So Tennessee's April unemployment rate of 3.1%, so the blue line on your screen here, was 0.8 percentage points below the U.S. unemployment rate of 3.9%. And this Tennessee unemployment rate of 3.1% matches the all-time low that was set back in April of 2023, held for 3 months. So Tennessee's unemployment rate has never dipped below 3.1% since the BLS started measuring this number in, I think, like 1976 or so. The national unemployment rate, meanwhile, 3.9%, is the highest that we've seen since this January 2022 observation, which was 4 on the dot. So workforce participation, on the other hand, remains a struggle for Tennessee. However, we are not alone in this, as the graph on the screen will indicate, that really since the turn of the century, this has been a bit of a regional issue for the Southeast. We've been experiencing this downward trend really since the turn of the century. So on your screen, Tennessee here is represented by the red line, and the other 9 states are the states that make up the Southeast, according to the BLS definition. And so Tennessee's labor force participation rate in April was at 59.6%, which, while that's the 3rd highest in the Southeast, it's actually the 11th lowest in the U.S. So really sort of underpinning this theme of a regional downturn in labor force participation rate, which we can get more into in our panel discussion. But we see it being further exemplified or exaggerated with the onset of the pandemic, and so maybe some early retirees and some people choosing to or deciding that they can live off of a single household income. Perhaps that's an interesting topic for a later discussion as well. And I know I'm a little bit behind where I wanted to be right now, so I'm going to kind of speed through these a little bit. But taking that Tennessee lens just back on the commercial real estate thing, we mentioned the soft national demand, but Nashville did see positive demand for commercial office space in Q1. A good way of looking at this is the quarterly net absorption. That's the amount of newly leased square footage minus the amount that has been vacated. So there were 12 major markets in the U.S. that had quarterly net absorption that exceeded 200,000 square feet in Q1, and 2 of those 12 were Memphis and Nashville. So, Tennessee and Nashville specifically have not been immune to the downward trends in commercial real estate, but perhaps these numbers offer hope that our market can outpace the rest of the U.S. there. Looking ahead, just a brief economic outlook, a couple of the things that we're keeping our eye on. That's the rise in AI and inflation monetary policy. Starting with AI, 1 year after ChatGPT hit the market, more than half of the companies surveyed have implemented generative AI in some area of their business. And while we're seeing this on the consumer side primarily through these language models, ChatGPT and Microsoft Copilot, used for rules-based administrative workflow tasks like writing emails, summarizing text. If we follow the money, it's easy to see that companies believe in enterprise-wide applications of AI and continue to pour investment dollars there. And lastly, just wanted to do a quick touch on interest rates. I think it was a week ago today, the April CPI numbers came in, and the data showed inflation up 3.4% year over year, and it's coming off of 3.5% from March, just the month before. Headline inflation was 0.3% on a monthly basis, which was slightly softer than the 0.4% increase in prices that economists expected. So we're seeing progress made, but the average American, of course, still having their dollar stretched thin. And while April's consumer price data was encouraging, it was not sufficient to trigger imminent rate cuts. So, of course, this is changing every day. I looked earlier today, and traders are currently pricing in roughly a 60% chance of a rate cut in September, according to the CME Fed Watch tool. That number has actually decreased quite a few percentage points from earlier in the week, and initially was as high as, I think it's 70% following the initial release of this April CPI data. I think that's an interesting point of discussion for our panel as well, and perhaps we have some interesting perspectives on the call to talk more about that. So I think that I'll leave that there. But of course, the interest rates and how the attempts to curb inflation will have a crucial effect on everything we've discussed today, from consumer behavior to investment decisions, employment, labor force participation, and even commercial real estate. So I think that I'm going to leave that there. Again, I thank you all so much for giving me the opportunity to present today. Looking forward to continue discussion with the panel. And I've included my contact information here, as well as Cassie Stinson, the director of the Center for Economic Research in Tennessee. Please follow up with any questions that you may have for us specifically, but I know that I'll get with Chris to make sure that we get these slides out to all who are on the call. So
Jackson, that would be amazing. This has been
yeah,
an incredible presentation, so full of, I think, a lot of really useful data. I know for me in the work that we do at Launch Tennessee, walking away with, the fact that there's been this 2x rise across the Southeast in dollars invested over just 6 years is very significant. And I think points in the direction a lot of people on this call are very hopefully excited to see. So,
yeah. Thank
no,
you, Chris.
no, thank you.
Let me give you your screen back. I really
Okay.
appreciate it. And
Awesome.
there we go.
So as we move into the next section here, Jackson has just dropped an incredible amount of data, here on this call, and so we'll make sure that everyone on the call has access to that presentation. But if you have some quick takeaways like the one I just mentioned, feel free to drop those in the chat, and we'll keep the conversation going that way as well. But as we move on into the panel discussion, which we're really excited about, I'll let the panelists do their own intros, but we've just been super pleased to be able to work with Cassie Stinson from TNECD, Laurel Grafe from the Federal Reserve of Atlanta, and Dr. Jerry Parrish, and putting together a really robust conversation. These are folks who are absolutely experts in this field, who have a ton of really incredible insight that I know that they are excited to share. And so I will shut up and get out of the way so that Cassie can take the panel from here.
Thank you, Chris. And thank you to everyone for joining the event. I really appreciate Jackson providing us that overview that he did with his slides and some up-to-date information for us to all consider going into this discussion. So it is a great pleasure to be a moderator for today's panel discussion. As Chris mentioned, I'm Cassie Stinson. I am the director for the Center of Economic Research in Tennessee. We tend to call it CERT to make it a little bit easier. And CERT is the research division within the Tennessee Department of Economic and Community Development. Although I recently joined ECD, I have been with the state of Tennessee for nearly 6 years, including several years as a data and policy analyst. My educational background is actually in international development, so it's a little bit broader than the development talking about like Tennessee or Southeast or specific to the US, but these are topics that do typically span national, local, and even international trends. And I'm really looking forward to our discussion today on the current economic climate and market trends as well. So before we jump into the discussion and some broad questions for our panel, I wanted to give Laurel and Dr. Parrish the opportunity to introduce themselves and tell us a little bit more about their backgrounds. So I'm going to turn it over to Laurel to go first.
Awesome. Thanks, Cassie, and thanks everyone for being a part of this. I mean, it is the afternoon. We are after lunchtime. I would like to keep this as lively and interactive as possible. Look forward to the discussion. So, Laurel Grafe, I lead the Federal Reserve's presence in Nashville, and I like to think of the work we do. So the Fed does a number of things. So, we manage the payment system for the country and, manage the physical supply of cash for the world. We supervise banks and kind of think about broad financial stability issues across the economy. The portion of the Fed's work that I'm involved in is around monetary policy. So I run a team in Nashville where we focus on basically the end result is forming hopefully an informed perspective about not just where the economy is, but where we're going, so that I can advise on monetary policy. And I do that with we have PhD economists who do the things you imagine PhD economists would do, crunch numbers and run economic models. We do surveys of business leaders, but I would say the perspectives that have been most impactful for me personally, and I think have been growing in influence within the policy space generally, but certainly within the Federal Reserve, in helping us understand where the economy is going, is actually having conversations with decision makers, leading firms, leading educational institutions, NGOs, because I think we're realizing that just looking at backward-looking data actually is not enough to help us understand where things are going. Like, yeah, I know inflation is too high. How is it actually changing the way folks are thinking about investment, thinking about workforce, thinking about your risk appetite going forward. So my space is in how can we actually connect data that we know and love so well, but tells a really incomplete story of the past, and connect that to real world lived experiences to help us get a sense of how we can position policy for the future.
Great. Thank you for being here, Lowell. Dr. Parrish, would you like to go next?
Yes, thank you, Cassie. I'm Jerry Parrish. I'm the chief economist of the Metro Atlanta Chamber, and we are, among other things, the economic development agency for the 29 counties of the Atlanta metro area. I've been in this job about a year. I was with the Florida Chamber Foundation for several years before this. I was on the faculty at Florida State University for about the last dozen years, teaching in the Master's in Applied Economics program. What I do here at the Metro Atlanta Chamber is certainly I write reports and do economic analyses, but most of my job really is, yes, I'm an economist, but my job really is as a translator. And what I say is I translate business and economics to legislators, legislative stuff to business people, and economics to basically anybody that will listen. So do a lot of forecasting, do a lot of analysis about really what's going on in the business community, but especially here in the Atlanta metro area.
Great. Well, it's great to have you with us as well, Dr. Parrish. To start off our discussion, I really want to touch on some very high-level current state of the economy for our discussion, specifically in terms of what some are calling the silent recession. And by silent recession, we're referring to the situation where you see good economic indicators like a stable stock market or the unemployment rates remain relatively low. But on the other hand, you still have people talking about how they are struggling paycheck to paycheck, or they're really having a hard time with slow wage growth, things of this nature. And depending on how you look at the current economic state, some people see a conflicting view where it's like, on one hand, the economy looks great. On the other hand, people seem to be struggling. So the first question for us to discuss today is, how would you characterize the current state of the economy, particularly in light of the silent recession? And what indicators or data points support this characterization? So Dr. Parrish, would you like to go first?
Sure. Well, this disconnect between, the economy numbers good, but people are really feeling like that we're in a downturn. And one of the main things I look at is the University of Michigan's consumer sentiment. And what are people thinking? Because that's a really good indicator of how people are going to spend in the future. If you're not feeling very secure about your situation, spending's going to go down. That's going to bring down the economy. But one of the things that I really think is happening here is it really depends on what age group you're in and what income group you're in. If you're younger and just got out of college and you've got student debt and rents are going up and gas prices are high, it's very, very difficult, and you're not going to have a good outlook on the economy. But if you're older like me and maybe you've got a 2.7% mortgage and maybe your house is paid off, the stock market's up, you've got this wealth effect going on, you really aren't feeling the effects that people in the lower income brackets are. And so we've really, kind of a bifurcation of folks out there. So it depends on who you ask. The older folks who are stable in their careers and have really good prospects about continuing those, their optimism is really good. They're investing, they're spending, they're traveling. It's the lower half of the income spectrum is what's really, being affected the most here, as it usually is when you have inflation and higher interest rates.
Yeah, so I will agree wholeheartedly with you, Jerry, around segmenting out the economy. I mean, I would specifically call out younger, and I would not even say the bottom half. I would say maybe the bottom fifth of income segments that's just really struggling. I mean, that group has finally kind of tipped into territory where they're financially worse off than they were pre-pandemic. and are indicating really pretty powerful signs of financial strain. I would include with that, though, that we're comparing to 2019, which was a time, if we all kind of time travel back into that period, people said a recession has to be coming because this has been the strongest, longest period of economic strength without a recession in modern economic times. And so even though people have returned back to sometimes 2018, 2017 financial well-being, from a historical perspective, I mean, this is part of, I think, what can be helpful to disentangle macroeconomic things that have a macroeconomic impact versus things that have a humanitarian impact, where this is a segment of the economy that doesn't, by definition, have a ton of spending power, and don't play a very big role in terms of their consumer choices in kind of broad economic factors. I mean, does that mean we should dismiss them or not care about their experience? Absolutely not. But in terms of looking at who in the economy has spending power, how are they actually feeling? And I will, because I'm trying to do this more on panels, I'm actually going to push back a little bit, Jerry, on your assessment of consumer sentiment, because in my view, it's interesting. Things have changed a bunch. And I don't know, Chris, if you don't mind taking down the slide so we can see each other's faces and participants' faces. So there are a bunch of measures of consumer sentiment. And one thing that I find, and I push my team on this a lot, there's data that we've been talking about for years as like, okay, here's the important data. And I always want to push to like, what's the so what? So if someone tells me consumer sentiment is in recessionary territory, like, oh, that's a bummer. I hope mental health professionals are thinking about that. How is that actually changing behavior and investment appetite? So, I go back to a year and a half ago when every single major economist truly was predicting definitely 2023 is going to be a year of a big US recession. And so I was out and about in public and I was talking to people and everyone was like, gosh, the Fed is so out of touch. How are you not prepared for this recession? And I'd say, oh gosh, big deal. My gosh, a recession. What are you seeing in your firm? How are you preparing for a recession? Tell me about your pipeline. And almost uniformly, they would say, well, my pipeline's good. I just know a recession's coming because I hear about it in the news, or everyone knows this is happening. And in some ways, I think of consumer sentiment in a similar way, that if you actually dig into the details of these consumer sentiment surveys, if you ask households, like, how are things? Or is the US economy in a recession? If you ask people about big picture macro indicators, they tend to actually be very bad at forecasting outcomes. So if you ask them about inflation rates, for example, they're most likely going to respond based on like fuel prices. But if you ask them about their personal conditions, so how are you feeling about your job? If you lost your job, do you think you could replace it with another job that earned about as much? If your household was hit with a big unexpected expense, do you think you could cover it? Those metrics tend to tie much more closely to actual spending behavior and are actually a lot stronger. So while like as a country and as a democracy, absolutely, I'm interested in how folks are feeling about things. As an economist, I'm a lot more tuned into, and so what are they doing? And in my view, yeah, totally. Everyone wants to talk about a silent recession, but are you still taking your trip to Disney World? Likely so.
And I think that's one thing that I have seen a lot in the news. It's really conflicting at times because you hear interviews about people who are like, on one hand, they're saying wage growth hasn't kept up with the cost of food, for instance. You see, let's say you go on social media and you see those videos of back in 2019, this shopping cart cost X amount of dollars and now it's 50% higher. And we all see things like that. And there's a question that's kind of like in the back of our minds. Well, if let's say food costs have doubled, like a lot of people claim they have across the board, they've doubled, it's so expensive. Well, wages clearly haven't doubled in that same amount of time. But you also don't see consumer spending slowing down. So it's almost like this contradiction where, yes, it's costs more now, but you don't see the behavior change, which is what you were just mentioning. And do you think that's something that people feel like, let's say in a conversation, people sit down at a table and they all share this commonality that the food on the table last year cost less than it costs today. But at the same time, are they not feeling it as intensely as they feel like they are because they haven't actually changed their behaviors? So maybe on that grocery store receipt, they see the number difference and they feel like it's really intense and it's really going to impact them. But then when they actually go back to the budget or whatever they're actually spending for the month, they don't see that. And so they don't change the behaviors. How would you all consider like those factors on the consumer behavior?
Okay, I'll go ahead. Well, a couple of things that I think about when I think about spending, and we heard this term a lot coming out of COVID, that there was a bunch of revenge spending. You were cooped up in your house for 18 months and you ate all the people, so you're going on this fabulous vacation, spending more than you ever would have ever believed in your entire life. Well, now we're hearing this term, and it's not prevalent out there, but I hear a lot of people talking about doom spending. And what that refers to is people have decided, let's say a young couple have decided, okay, we'll never be able to afford a house. So let's go blow that money that we were saving up to buy a house for on something that some people would say was crazy. They're buying so we're seeing a lot of that, but we're not seeing it with the older established folks. And so I think once again, when you kind of separate it into the more established people, do you have a house at a reasonable mortgage? Yes. Is your stock market portfolio and your other investments up? Yes. Those guys are still spending a lot of money. And it's the other group that's not. And what you have to think about is the wealth effect is a big deal. It's been going on. I have to blame the economists for bringing down the group last year. First of 2003, Laurel's absolutely right. 85+% of economists were forecasting a recession, and it's because one of our indicators that has been so reliable about forecasting a recession, which is the yield curve inversion, kicked in July of 2022. And so all of us said, well, hey, that means 2023, we're going to have a recession. And I think the optimists have won the game here and kept on spending their money and kept the economy afloat. But also think about the consumer sentiment kind of indexes. When you invert them, it almost follows gasoline prices so a lot. So to wrap it up, I'd say something like, if gasoline and food is a high percentage of your income, then yes, you got a pretty dim outlook. Everybody else is adjusting. We're seeing ticket prices at restaurants going down a little bit. People are substituting cheaper things in their consumer spending. We're seeing a little of that now, and may see more of it here in the near future. But a lot of it's going to depend on the interest rates and what goes on. But keep in mind that the higher income folks and the older folks are actually keeping the economy afloat while all this is going on.
I'm happy to add to that or move to another question, whatever.
Yeah, go ahead and add your thoughts to that, and we'll move on once you do that.
Yeah, I think that was a really good overview. Maybe I will circle back to, you called specifically out kind of inflation feeling maybe mismeasured to some folks, and like, okay, you're telling me that, I hear this feedback a lot. You're telling me inflation is going down, but like, have you seen the price of a burger lately? Have you try to get a handyman to come to your house and fix your sink? Like, how can you tell me inflation's going down? And I think this is part of those areas when it's like, economists are not PR professionals, and it really shows that. So the inflation that I'm thinking about, the inflation I'm kind of live and breathe and sleep thinking about, is the average, the change in the prices of goods and services that the average U.S. urban consumer consumes. So it includes everything from a banana to health insurance to my rent to services that my employer pays for on my behalf, all of those sorts of things. So for the average urban consumer, food and energy make up an incredibly small portion of what they spend. But as we know, all of us have really different experiences. And so there probably is, if you average everyone's experience out together, you're probably actually describing nobody. Like nobody actually fits that description. And so it can be really helpful to within that parse out, do you rent your home? If you rent your home, you probably also live really far from work. You probably drive an old vehicle that uses more fuel. You probably are more exposed to grocery commodity prices than, say, to service prices in restaurants. And we know that the commodity prices have seen a greater concentration of inflation over the past several years than the services inflation side of things. So you have a relatively small but a very vulnerable population that has been a lot more exposed to higher inflation than the rest of us in general. And I think the other thing is just people don't know what inflation is. Like I'm shocked the number of CEOs who have Ivy League business degrees who say inflation's high because guess how much a gallon of gas is. And I think there's a real difference between price levels and price growth. So if we experience high inflation in the past, whatever the new level of prices is, we would need to continue to see accelerating growth or high growth on top of those new levels for that to be the sort of inflation that I would worry about. Other than that, this is just about kind of cost of living, which is an issue, but is kind of is to be talked about and I think solved in really different ways than like, look, the Fed's tools, if you want us to lower prices, we can do that. That would be an economic depression. Like you can look back to the era of the Great Depression or other kind of major sort of drought or wartime events. I don't think that's something that we should be trying to target. And instead, like, how do we empower people so they can meet the needs of staying alive, but without necessarily saying, okay, we're trying to target to bring the price of a sandwich down.
Mm-hmm. Yeah, and that is something that, you don't usually hear in the news, where you watch on the news and anyone who's like, oh, the inflation's out of hand, they almost always tie it directly to the price of something today, not so much like that long-term progress or the change that naturally occurs as economies grow, things of that nature.
Yeah. And
so go ahead.
Add to that, because inflation's I would say like inflation's the story in my world right now. If you want to look at where interest rates are going and when, that's the game right now, unless there is a huge turn in the labor market. And I'll say I still feel quite confident that things are moving in the right direction. So both when I look at the data, including, again, like no single data report is going to wish us over in one direction or the other. But over time, it's like, look, we made a record pace. We've seen record progress in bringing inflation down over the past year and a half. That progress has kind of slowed and stopped. It's been bumpy, but it looks like it's moving in the right direction. And that is, in some ways, I think one thing that's been remarkable when I'm out and about talking to people who set prices, which I always think of like, this is where you can see what's going to happen before it's going to show up in the data, is how are retailers, how are service providers thinking about their pricing strategy in the coming year. There is almost nobody, and that is true across, even sectors that are doing very well right now. Almost nobody is telling me they are expecting to increase the pace of price increases faster than in the past. In fact, almost no one is even planning to increase prices this year as much as they did last year. So I'm continuing to get pretty solid information that, yeah, maybe I can pass along a little bit stronger increases than was typical pre-pandemic in certain sectors. In the good sectors, not really anymore. If you're in the traditional good space, you're back in the sort of deflation, flat price space in general. But this is an area that I think we are moving in a really good direction. And I think it would take a shock to change that. Is this economy susceptible to shocks? Like we have all learned, absolutely yes, we need to be ready for that. They could come in any direction, but this is somewhere in some ways I find this story of consumers being really upset about high inflation and high interest rates a little bit perplexing, because inflation has actually come down a lot, and that progress seems to be in some ways in a really smooth place right now.
Mm-hmm. Well, continuing the discussion on the trends and where the economy is currently, what are some key macroeconomic trends that you think have contributed to the current situation? Obviously, like COVID had residual impacts that we've been dealing with, but there's many other factors that are playing into what we're seeing currently. And how have these trends affected the availability and flow of capital?
Look, I think a huge one, and I would say it's actually where the labor force participation action has been for years, is demographics. Like, we do not talk about this enough. It is something that is often, pushed to the side as a political issue. Demographics is actually, it's a lot easier place to play than like weather forecasting or economic forecasting. You can like count up the number of 17-year-olds last year and get do some estimate of like how many people are making really risky choices and like get a decent guess of how many 18-year-olds we're going to have this year. We are on the verge of moving in a direction where we are going to have labor shortages across this country in a way that really restrain growth. So I am thrilled to see the kind of pace at which technology adoption is trying to address some of that. But sitting down and having a very real conversation about an immigration strategy, about how difficult it is to be a parent, and how being able to work and raise children and kind of still advance in your career is not something that's accessible to a lot of people in this country. Like, it seems like I talk to employers and we have a whole conversation, and it's like, and they lean in and say like, not to be political or anything, but like immigration could help to solve a lot of these issues. And I think, okay, I don't know why we talk about this as a political issue. It is just an arithmetic issue. We don't have the people today, and we are not on a path of having them in the future. And I think having a real honest discussion about what that means, again, this is not the Federal Reserve's space to play. I think voters can make a decision. And if we want to say, we would prefer to have slower growth, we would prefer for our businesses to, have to pay more for labor and, have fewer resources to sort of grow and innovate, because we have some values around not allowing more foreign-born folks into this country. Like, that's okay. Voters can make that choice. But it doesn't seem like it's a conversation we're having out in the open lately. And I think that is a factor driving a lot of trends that I hear elected officials, I hear business executives, I hear employers often talk about things like, oh, as if the issue is lazy young people. When I'm like, look, this might seem like a surprise, but all generations always look at young people and think they're lazy and making bad choices. That's not we can do that. It is, bonding for everybody, but that actually is not getting us closer to a solution for, I think, a growing issue that we have a lot of visibility into.
I've got another one that I love the demographic conversation, because it is a big deal. So Laura's exactly right on that. Another thing that we all have to think about is kind of, I believe we've seen peak globalization, and we've seen a retreat from globalization for many reasons: supply chain crisis after COVID, in general, political fighting that's already here and more to come in a lot of cases. And in some cases, we're going to benefit from that here in the U.S., reshoring or nearshoring some of our manufacturing. Certainly that's going to help the supply chain. But, that's been a big issue. There's been a, pretty free flow of capital, reasonably free flow of labor across countries. But I think that now we have to wake up in this new reality that it's not, the percentage is not going up. Certainly it's going to go down, and that's going to have a lot of impact, and it'll impact consumers. It'll impact producers as well. But, there's going to be a lot of opportunity here for people in the States to create some jobs that probably would have gone to some other countries.
Yeah, and I think one aspect that, starts playing across all of this versus like the demographic challenges, immigration, you have outsourcing, there's all these various factors. But one thing that kind of sticks with me is that anytime you're looking at the availability of like labor, whether it's you have to go outsourcing so you can find more cost-effective ways to produce things, or AI replaces some jobs, or automation replaces jobs, at the end of the day, it's not as simple as like some jobs that are replaced by AI are just no longer needed. It requires a new skill set for some employees to have to be able to monitor the AI, or it requires a change in the skill set. You have remote work that allows some people to work across international boundaries. Like you could have someone in Europe working with somebody in the US, and it's not even a problem despite being in two different continents. But you can't just outsource all your jobs to remote, because a lot of jobs that can be outsourced for lower labor costs are not the ones that can be done remote. So I think there's a lot of these factors that start playing into making this a very complex issue. You can't just reach out and say, hey, let's all go remote. That will solve everybody's problems. But you also can't say just hire everybody in the US, because the cost might be too high. And I think that might be part of those factors that play into, this kind of push and pull. Are we doing hybrid, remote, outsourcing, automation? And then you got to train everybody along the lines to keep up with the ever-changing technology and innovation as well. So those are definitely some of those factors that play into the overall discussion of like, where are we and where are we going to be going in the future? So the next question that I want us to touch on is, in Jackson's presentation, he brought up that the tech sector had substantial layoffs over the past year or so. And everybody's heard this on the news, thousands of people laid off. So with layoffs occurring in the tech sector, what do you think is an underlying cause? And is it indicative of broader shifts in the tech industry, or is it primarily a response to the current economic climate?
Either
You
one.
want to go first?
Sure. And I will say I have about 15 more minutes before I have to hop. So if we do want to open it up to the group, it might be good to turn it soon. This is clearly tied to capital flows, right? If there is essentially free money flowing places, and I would say a bias from investors shifting from growth for the sake of growth to profitability. I think there had been a massive flight to talent from organizations that had access to a ton of capital, which led to, in many cases, overhiring, overpaying for certain skills, and also necessarily, the whole point of the point of the Fed having low interest rates was to encourage risk taking. And the tech sector is a really healthy place to lead that type of work. And by definition, with risk taking, some shots win and some fail. And so, some of this has been a really natural rebalancing. And at times I push back on a narrative that layoffs in the tech sector are necessarily leading, are leading layoffs across the broader economy. And instead it's, look, a lot of these organizations hired a ton of workers and are keeping most of them. And instead are kind of reducing teams in certain parts of the organizations, are retooling, are having to refocus from, look, demand is just flying by, and we are just having to hire whoever is willing, butts in seats who can help us move the organization forward. Demand is starting to become something that's a little more sustainable, a little bit more manageable. And so we're having the time to actually look at our operations and say, okay, do we have efficiencies here we could actually gain? How do we want to structure ourselves when we're not kind of in a full out sprint? So I think some of this, obviously there are real human costs to layoffs. There are real distributions here. There are, lives that are impacted, but I don't think by definition, what we've seen in the tech sector is necessarily a sign of dramatic weakness. In some places, has there been an overcorrection? In my just Laurel's own personal view is some of the focus toward, everyone wants to invest in a company that can make a case for how they are AI. Are you building an AI data center and are ignoring really other important parts of the economy that are the underlying infrastructure supporting that work, or are going to be kind of critical co-movers? So, some of it is, I don't always think all capital is smart capital. So some of this feels like an overcorrection to me. But again, for the most part, a lot of what's getting a lot of buzz in the media isn't something that I look at and think, oh, this is wildly unhealthy.
I think there was a big benefit to some companies because of those layoffs. Everybody, the young people want to work for Microsoft and Google and all those. There were a lot of companies that were able to hire somebody, that may have gotten laid off at a tech firm that really have added to the company's bottom line and filled some needed positions. I talk to business people all the time about different things, and that's one of the things that came out. Here in Atlanta, we've got a bunch of Fortune 500 and Fortune 1000 companies, and I see their CEOs once a month here in this building that I work in. And so I get the chance to talk to them, and And I think for the most part, those people were absorbed in the labor market, are being productive. And I think that's been a big benefit for them.
All right. Well, Chris, I have a few more questions that we can jump into, but do you want to see if there are any questions to start with? That way I don't use up all of our time if others have some specific questions they want to ask.
Absolutely, absolutely. So just really quick reminder for kind of flow here. If you have a question for our panelists, please use the raise hands function and I will acknowledge you and you can unmute and ask your question. We'll just kind of give it a couple seconds for people to find the button. Should be down the toolbar there.
I like that you're offering acknowledgement. We have outside of my gym in Nashville, you can get parking validation. So you go to the front desk, and there's one of the women who works at the front desk was a former teacher, and she offers validation, and you can choose if you just want parking validation or also personal validation. And so, which I always opt into that. So it's like I both get my parking covered, and I'm also like, you matter because you are, or I can see you're trying your best or something. So I'm expecting something similar with the acknowledgement, Christopher.
I mean, I can definitely swing it. You guys all are doing a great job. So seeing no questions unless somebody just couldn't find the button, and let's just go ahead and unmute and ask something. I'll kick it back to Cassie. Cassie, you want to ask maybe at least one more question before
Yeah.
Laurel has
Well,
to-
this one, I think this one will be a good one to finish off our conversation. So this is one of those looking ahead. So looking ahead, what are the key factors or developments that you believe will determine the trajectory of the economy in the coming months? How can businesses and investors prepare for potential scenarios and mitigate risks?
I'll start if you want me to. First of all, let's say thanks to the Federal Reserve folks. They had an almost impossible job. I equated it to landing a 747 on one of these curvy mountain roads up here in North Georgia. You have the same in East Tennessee. It's a difficult thing landing an economy smoothly without tearing up a bunch of stuff. And to have that quick of an interest rate rise, all of us economists said there's no way they could pull this off. I mean, honestly, it was almost impossible. Yet you continue to see inflation coming down. There's a few things that are really, big year over year. Car insurance, 20+% increase year over year. And those are the kind of things that people think, when they see their bills, it really kicks them back into, holy crap, inflation is out of control. Give them credit. The bad news is killing the last point or so of inflation is very difficult to get down to the 2% target. So we're still going to be in that situation. Remember, the market earlier this year was predicting 6 or 7 interest rate drops during this calendar year for the Fed funds rate, and we've had 0, and maybe have 0, 1, or 2. We don't know by the end of the year. Certainly. Jackson talked a little bit about that in there. So the market needs to be patient. Certainly, we have to kill inflation while we have the opportunity to do it. People like me lived through the 70s and 80s when, we took our foot off the gas and inflation came back, higher and bigger 2 more times. And we ended up with literally 14, 16, 18, 20% 30-year mortgage rates. And people don't understand. People like me understand, hey, 7.5, it's not great, but it's better than it could be. So we have to be patient. But I believe that a lot of people think that we're going to come out of this thing without a major downturn of any type. And that's what the folks with capital are thinking about right now. There's opportunities. We see, there's going to be some keys handed back to commercial buildings. We are already seeing some of that during the refinancing, certainly, but that's going to provide opportunities for business that may want to move into those spots, may want to come to your state, may want to come to the state of Georgia as well. It's going to provide opportunity. And so far, the Federal Reserve has done a great job I get to see, President Raphael Bostic, the head of Atlanta Fed. I see him in a lot of meetings. He actually was the last interview I had. He used to be our chair here at the Metro Atlanta Chamber. And I had to interview with him before I got this job. So I always say thanks. Thanks, Raphael, for doing a good job for you guys. But I believe we're on a path to smoothness to where people will feel more comfortable dedicating more personal capital. Yes, interest rates won't come down to what we saw. Nobody's expecting that. But it is going to be an opportunity for businesses that have maintained stable incomes and maintain their customer base, and even for the startups, to start seeing more private capital come in to help them develop their companies.
That was a great summary. I would maybe first say thank you, and also I think sometimes the Fed gets credit for things that are luck. And the problem about taking credit for good things that are luck also means that people point their fingers at you to solve problems that you actually can't solve. So, it does shockingly look like, okay, this thing that no one thought could happen, maybe it actually is possible. There's still plenty of time for us to go into recession. It's not what I'm expecting, but I never call victory. I said inflation as a big thing to look for. Absolutely. If you're thinking about capital costs, we are paying very close attention to that. I would specifically pay attention to services costs. So if you can see, there's kind of breakdowns of inflations that pull out services and look at, obviously if you're a services company, your biggest input is labor. So labor costs, services costs, that's the angle of inflation that I think is going to be kind of driving when we make a call about when and how to cut rates. I think the other thing that still has me up at night, even though I started out this call arguing that things were still pretty good, is one of the things that's very unusual right now is when we are tipping into a consumer recession, when we are tipping into a point where consumer spending is contracting, we see things that we have already seen. So what tends to happen is as workers are squeezed, you see the very lowest income segment of the population, they start trading down, they shop on the 15th and 30th of the month when they get paychecks or government support. They're sort of shifting to lower cost goods. You're buying dish soap in order to do all of your washing instead of buying shampoo and laundry. So you are seeing already the full signs of distress on the lower income segment. The thing that's unusual is typically that ends up slowly working its way up different income groups, and it just hasn't. And as I'm out talking with the businesses that I think have the best visibility into that, so the folks who cater to lower and moderate income consumers, people who do, I think, a really good job of understanding their customers, getting focus groups together. Really, the distinction is most workers still feel really good about their jobs. And even though they're complaining about inflation, they are currently seeing inflation adjusted wage gain. So their wages are growing faster than their cost of living right now. I think if that changes, bets are off. That we have been in this period where workers are saying, look, I feel pretty good about my job. I have this new expectation about my standard of living. And I am willing to prioritize those things that matter to me. I will maybe buy store brand produce at the grocery store. I'm willing to trade off certain things, but there's a certain standard of living that's important to me, and I plan to support it. And I think I can because of my job. If there is a change, I would say for the lower income segment, so not lowest income, so I would say bottom 4/5 or top 4/5 of income groups. If we start to see more strain working its way up the income group, that would be a sign to me that the economy is turning, and we have really majorly been relying on consumer spending to fuel this recovery over the past few years. So if we start seeing indicators that story might change, I would pay very close attention to that, and kind of the way I think about capital flow and the kind of distribution of strength across the economy could change pretty quickly.
All right. Well, I will pass it back to Chris. Again, thank you both for being on the call today. It was really great having these conversations with you. And thank you to Chris and Launch Tennessee for inviting us all to come and speak. And this has been a great opportunity, and really appreciate your ongoing efforts and support for investors in Tennessee and our region as a whole.
Thank
No,
you.
the absolute pleasure is all mine, and I extend that from the rest of our team as well. Thank you, Cassie. Thank you, Dr. Parrish, and thank you, Laurel. It has been a pleasure to sit and just learn from you all. I know I've taken away a few post-it notes here of some keys here. I've just a few that came out that were big for me. You know, segmenting being really important in these conversations. That the lower half of the income spectrum is really feeling the burn here. And maybe even the bottom fifth are really feeling it very strongly. I had not heard doom spending before, but apparently Ziggy on our team had. I need to spend more time on TikTok, I guess. And then, you know, really food and fuel as being key indicators as a function of a sort of percentage of his expenses, I think is really an interesting and important note for all of us to look at as we look at the broader economy. So thank you guys so much. I mean, like I said, I've got a bunch of post-it notes here that I'm going to probably be going over here with our team, but thank you. We will now move into our breakout sessions where